I think anybody who's involved with the consumer sector in any way probably knows it's been a very volatile, very up and down year. And I think there are a lot of big questions that need to be answered about the second half of 2025 and potentially the years ahead. And I think a lot of the foot traffic data that we have can at least give you some insights to what's been going on so far this year. So if you've been with us before, you know Deborah and I like to cover a lot of topics here, and today will be no different. So we've got a lot in store for you. So just a quick reminder in terms of the agenda for today. Stephen already mentioned this, but we'll just do a quick 2-minute intro on what Placer.ai is and how we get our data. We want to save most of the time for just kind of discussions about big picture trends that we're seeing. And if there is time, we will have a Q&A session at the end, but certainly ask questions as we go along. We'll be throwing a lot of data at you. So I know that if there is something that catches your eye, please let us know. So just quickly, in terms of what Placer.ai is, we are a location-based analytics company powered by mobile data. In simpler terms, that means for any physical place in the United States, whether that's an individual retail store, shopping mall, downtown area, airport, effectively anything you can draw a shape around on a map, we can get foot traffic data for. The way it works is we partner with several different mobile app companies, and through those app partnerships, we now get 24/7 data on a panel of over 25 million devices. Importantly, no personal information is sent to us. That's all stripped away before we even get the data. So we don't know that it's a certain person's phone that went into it. We just know a phone went into that polygon that we drew into on a map. At this point, we work with over 5,000 customers across the retail, restaurant, CPG, finance, and civic verticals. They've all gone through a rigorous process testing our data, feel pretty good about the credibility and accuracy. But more recently, on the next slide, we've become much more than just foot traffic data. I'd like to think of our data as kind of the what, how many people come into a particular location, how long they stay, where else they shop. And this is a good foundation, but really to get the why and the how, it's our other third-party data sets that we layer on top of it. I mentioned that we don't collect any personal information with our data, but we're still able to look at where a device goes back every night to the zip code block. If we know things about that zip code block, we can make inferences about things like household income and ethnicity, and get a better understanding as to why and how, what's going on in the situation. So lots of cool stuff, visitor journey, cannibalization, event studies, rankings. If you haven't seen us before, please check us out at Placer.ai. Got lots of free content, lots of free data tools as well. So we'd love to talk more if you're interested in learning about some of the ways we're putting together the data for today's presentation. So with that, Stephen, let's get to the fun stuff and really dive in. And it's kind of a starting point. I mean, when we were discussing the, getting the preview or the, kind of preparation for this presentation, one of the things that Deborah and I were talking about is this has been one of the more, if you exclude COVID, this has probably been the most interesting year in terms of consumer behavior since the Great Recession in 2008. It really has. Almost every week, almost every day is almost a new story, and you kind of see it in the data here. This is what we're showing is year-over-year visitation trends for all of retail. I think this is effectively a collection of over 500 retail chains that we put together. Started out January pretty strong. We were lapping weather from January 2024. But then we got to February, which was one of the weakest months that we'd seen in many years, to be honest. I think we had several factors at play, a lot of discussion about tariffs and a lot of uncertainty behind what was actually going to be affected. We started to see weather being an issue. We started to see headlines about immigration, headlines about inflation, egg inflation was starting to kick in. We started to see headlines about government restructuring and consumer protests. So it was kind of a kitchen sink period where people really didn't know what was going on. And I think that definitely impacted overall visitation trends. Then as we got through kind of the next couple of months, we'd see pickups right before tariff implementation. So we saw right at the end of March, end of April. Admittedly, there were some holiday shifts in there too with Easter. Then we kind of settled into kind of a normalization period and kind of a wait and see period kind of during the May and June timeframe before we got to at least July, where we started to see at least early in the month a little bit of weakness, a little bit more uncertainty before we started to see a little bit of a rebound. But, Deborah, I want to get your take on this too, because it really has been something of an up and down year. We look at the data and, consumers, I think, are being pushed and pulled in a lot of different directions there.
Yeah, I think at the beginning of the year, we saw kind of across all income classes, more similar behavior and a more similar outlook. I would say kind of since that March, April timeframe you discussed, we've started to see more of a bifurcation. And so I'd say consumers in like the 50 to 100,000 household income have definitely kind of pulled back. Those under 50 have really pulled back, and those 100,000 and over, if you think about it, those more directly tied to the market and to housing, they continue to feel good about themselves and also good about the economy. And so that's, I think, continued to spur spending.
Yeah, and that's exactly what our data is showing too. I think you're right that when we saw the big dip in February, I think that was something that impacted everybody. Now, as we kind of move through the year, I think you're right. I think we are seeing kind of the K shape, the bifurcation, whatever you want to call it there, in terms of visitation trends. We're definitely seeing that too. I would say that 50 to I would even extend it to maybe even up to the $120,000 mark. That is a group where we've probably seen the most change in behavior. That's the group that seems like maybe maybe it's lack of savings, or just the impact of inflation cumulative the last couple of years. That is a group that maybe is now starting to trade down, trying to trade out perhaps. We've seen it with visitation data. When we look at kind of the Walmarts of the world, in terms of where they're picking up, it's definitely that group, and even maybe a little bit higher. Dollar stores are starting to take a little bit more share from that group as well. So we definitely see that with our data, and so I think we're seeing that bifurcation take place.
Also feel like we're seeing consumers do more research before they shop. And I think, your data is kind of proven over time, right? You're seeing in aggregate, they're spending more time shopping, kind of visiting more retailers. There may be more information, there may be more of a focus around kind of getting that great deal, and there are more deals.
It is. It's interesting what we've seen, and we've looked at it primarily in grocery, but it has applied to other categories. But this idea that people are shopping around to more locations than ever, that was true at least through 22 through 24. 22 was the period where we started to see both food at home, food away from home inflation really spike up. People started shopping around. What that happened when they started shopping around is that put downward pressure on dwell time. That was probably also a byproduct of buy online, pick up in store. Also, to your point, people doing more research ahead of time, but downward pressure on dwell time. If we overlay retail sales data on top of our visitation data, we also saw that retail spend per visit come down. What's interesting is we go to 2025, though, there is an interesting takeaway with this too, is that in the last couple of years, people were more willing to try and experiment new retail. Like, hey, I'm going to go try out that Aldi. I heard good things about it. I'm going to go to Trader Joe's. Now we're kind of settling in. People have kind of been a little bit more selective in terms of adding new retailers. I feel pretty good about the collection of retailers I go to. It's going to take something pretty monumental in terms of a deal, or something that I can't get anywhere else to get into it. So that's one of those things from a behavioral standpoint that's really caught my eye this year, at least in terms of people are almost kind of fiercely loyal to the brands that they feel represent their lifestyle, and so it's got implications for visitor acquisition costs at this point too. It's harder to get people in the door right now, even with deals. But I would say over the last couple of years that certainly was true.
Well, it's interesting though to see, right, the kind of cadence of how I think people are doing their research. And I do think with Gen AI, right, we're starting to see, I mean, data, we've said as high as 50% of consumers are starting their shopping journey there. And so this idea of how you're doing your research, so maybe there's a greater overlay in terms of the right, that just gets you to the end much faster than what we've seen in terms of, yeah. It's an interesting idea in terms of how we're seeing some of the changes in behavior and how rapidly. I mean, in New York, we've actually gotten a lot of new retailers. So it's been interesting to see, right? I think Lidl opened and there was like a line around the block. And so, right, there's a lot of engagement in what's new and kind of like what's next, right? We got Luckin Coffee, right? Like brands that didn't exist here before. And so I think we are seeing, right, kind of excitement when there is something new, but that's kind of few and far between.
Yeah, I think that's right. I mean, I think one of the things we've seen, I would put New York in probably a separate category here too. One of the things we've seen, at least, and it's come up a lot more in the restaurant sector than it has in the retail, but one of the things that we saw is that, post-pandemic, 2022 was a big year of expansion. Everybody had kind of put their expansion plans on hold, but 22 was the year kind of unlocked and unfroze. And all of a sudden, we saw a lot of markets, particularly in the Southeast, that saw boom and expansion. We're talking about like high single digit, even low double digit in terms of number of new retail and restaurant locations that opened up. And so what's happened is if you were a new brand who also chased that market, it's been really hard to stand out. That's kind of one of the big factors that we've seen. Now, I'd say there's certain brands that kind of elevate above that. Luckin has been certainly one that, if anybody followed the story in China, it was amazing to see how many stores they were able to open up so quickly, and it'll be interesting to see how it plays out here. But yeah, I think there certainly is that element of newness that excites people too. But there's also a lot of more competition in certain markets for that newness as we've seen expansion plans. So Deborah, this is one I know we were excited to talk about too, but just, as we got through to July, I mean, obviously Prime Day and the ripple effect it has across the brick and mortar and even online retail space too has been certainly interesting. And I think this year was something of a mixed bag. In the past years, we generally saw that Prime Day helped to elevate a lot of retailer visitation trends. Maybe that was because people couldn't get that Prime Day deal, wanted to go check it out their store, maybe they wanted to compare pricing, but it's a little bit more of a mixed bag this year. I mean, we did see Walmart and Best Buy see year-over-year trends compared to their year-ago sale period. Dick's Sporting Goods was another one that did see a nice little pickup in year-over-year visitation trends, but some of the other ones were a little bit more of a mixed bag compared to last year's sales events. So Target and Kohl's and Dollar General, in terms of the visitation trends, the retailers that actually had some sort of marketing around the Prime Day events and kind of their own spin on it, it was a little bit more of a mixed bag. So I don't know if that kind of meshes with what you were seeing in terms of the data as well, Deborah.
Yeah, I mean, outside of Amazon, and even we spoke to a lot of vendors who had mixed results on Amazon. So that was also interesting. And right, there was a lot of retail media spend. So definitely a lot of chatter there. But outside of Amazon and the brands that were there, and there's retailers obviously who sell on Amazon also, our data really matches up, right? We saw kind of Walmart, Best Buy, Dick's, and Ulta. Those were the four who really, I think they leaned in with their own message. They were very kind of specific about what they stood for. And what's interesting is, like, that week was kind of a very, I would say 25% of people I know were on vacation that week, right? That ended up being, right, because if you think about it, the 4th was Friday, and then people ended up taking that next week. I don't know if, like, I think that, when the 4th is on a Thursday, you're kind of taking that earlier week. And so I think that may have led to, some retailers misreading maybe what to advertise or how to think about that week, because some of the messaging and what was advertised did seem off, and I would say the results here kind of match that. And so I just think that people didn't necessarily read the tea leaves very well.
It was interesting, that 4th of July timing, that Friday. We've actually put some thought into that as well, because I think that kind of did, it not only screwed up the week after, but I also think the week before, because you did have a lot of people on vacation that week before, and so we saw pretty weak visitation trends. And I think a lot of the messaging about the sales came out that week, and I think a lot of people just missed it that point too. So I think it was like a quiet 2-week period there. And I think there's certainly some macro at play there too, but I think it was also just kind of weird timing from a holiday and vacation standpoint as well.
Well, it was really interesting, right? We saw a lot of kind of, from an events perspective, right? Like that last week of June, right? We had our conference then. I mean, it was like the week of conferences, and then, right, kind of everyone was very European in their approach, and right, July was very quiet. And I think that even those who expected those first 2 weeks to be quiet, I think it was a whole different level of quiet than expected. And I think it was, people delved into spending time with family, going on vacation. I don't know if necessarily shopping was top of mind. And I also think it was a point where everyone was able to kind of digest everything from, all the activity, and really started to also, right, we had a lot more inbounds around a lot of the, we'll call it tariff math. And so I think maybe when people were shopping, there was also a different level of thought process put into purchases. But yeah, that was an odd 2 weeks there.
Yeah, and I think that you set that up nicely, because on the next slide we show just kind of some impact to some certain retailers with tariffs. And I think it was interesting kind of watching progression. I think certainly February, and what we're showing on this is some of the categories that may have been impacted in some way by tariffs. So electronic stores, wholesale club, dollar discount. February is a period everybody was just like, I hear a lot of news about things, I'm going to pull back. We get to certain periods, like, again, we saw a nice pickup at the end of March for warehouse clubs. Admittedly, there was also the Easter overlap on that, but looking at the 2-year data, also seemed like people were stocking up ahead of that. Then we kind of get to this period of kind of normalization, and then it was kind of as we kind of had that 90-day push out for the tariff implementation date. But as we kind of got to, you're right, I think early July was the point people started, okay, maybe I should take a look and see what this potentially could be. I'm going to sit back and focus again on tariffs, and I think that's had a big impact. I mean, I think if nothing else this year, looking at our data, it almost ties back to your point about consumers doing more homework than ever before going in. I also think consumers are they're hyper aware of prices. They're more aware of the prices they paid last week, last year for certain products. I mean, you've got a phone in your hand, you can pull up your orders for Amazon and see what you paid. You can pull up other apps, you can pull up whatever it may be, and people are aware. And so if they do see that 5-10% price increase, they're going to think about it. I mean, especially if people are announcing it. I mean, it was interesting watching what happened when Waffle House and Denny's put an egg surcharge in February. People balked to that pretty quickly, and even when it was still a relatively benign price increase compared to the overall meal. When people hear about price increases, they want to get in front of it. And we see that pretty quickly with our data. I mean, warehouse clubs, again, usually week to 2 weeks ahead of a tariff implementation, people are going to do that big Costco stock up trip. So it's something we continue to see. And again, we see it with some of these other categories too, like electronics. We saw, admittedly right before some of the tariff implementation periods. Now, admittedly, there's the switch to that kind of, is distorting a little bit of that data as well as we kind of move into the June timeframe. But been pretty interesting to see how aware consumers are about pricing and tariffs, at least kind of keeping an eye. And if, there's other than, lack of inventory, pricing right now is one of the bigger motivators to get people in the stores.
Well, it's also interesting you start to think about the switch to is not a small ticket, and that consumption, what that took out of other things. And then I have no idea. I dove very deep into this one, right? So you look at, right, you buy a new game console, right? And then the timing, right? The next 3 to 6 months are games. And then kind of at 6 months, you're buying kind of accessories and cases and all. Like it's a really interesting, right? But it kind of and additional game hardware. And so, right, you've probably got 6 to 9 months really of, for those into, kind of Nintendo 2 Switches, right? There's a decent amount of mind share and spending that's kind of been pulled forward potentially from maybe holiday or whatnot. And so I think that that's something to think about, but it was also interesting in terms of the timing of the release, right? Far from kind of one side of holiday or another. And I think it's been really interesting to see how they're doing kind of additional, just say inventory drops, and how they're kind of allocating that to different retailers as well.
Yeah, I think what your point about the pull forward is very interesting, because the timing with the June release there set up nicely for that. You're exactly right. Typically, that accessory timeframe for that is kind of the call it 4 to 6 months after. I think a lot of that got picked up in that the Prime Day, the best day, both Prime Day and Best Buy picked up a lot of those accessory sales for Switch 2 during that July timeframe as well. So that may have also pulled forward a bit of demand ahead of holiday. Obviously there's a lot of variables between now and the end of the year too. So it'll be interesting to see how that plays out. But it's been very interesting to see that consumers quickly balk at price increases, especially after all the inflation they've been dealing, not only in food, but rent and healthcare and other kind of basic necessities as well. So it'll be interesting to see with where pricing goes. And I know looking at inflation, we're creeping back up in that 3% range. It'll be interesting to see where that plays and how that impacts. But again, consumers are very aware of pricing right now.
Well, it's interesting because you have some things that are kind of so right now we have the most inventory landed that we ever have for a holiday season in history, right? In the US landed, it's here.
Yep.
We'd advise all of our clients, get it in, right? If you can put it in January, do that. And if you can raise prices in January, do that too. So I think, so that's interesting, right? You've seen kind of double-digit declines, right, in terms of inbound freight, which of course also makes sense. And then third, we've heard a lot more about kind of this like 10-week period potentially of, right, we could potentially have the greatest rise in inflation that the country's ever experienced. And so we believe that we're going to see, and some of the data already suggests that people are trying to shop in different ways. So once again, doing more research, looking at more secondhand, kind of really and it's interesting, right, from a back to college timing perspective, how that may or may not kind of impact some of those sales.
Yeah, it's a great point too, and it's interesting when we look at our visitation data to both port and manufacturers. You're exactly right. We've seen a pretty dramatic decline in the at least the port activity in terms of year-over-year visitation trends, which will measure both employees as well as logistics partners picking up products from there or dropping off products in there. So that's very interesting. We've seen that too. Manufacturers have also pulled, at least domestic manufacturers have pulled back. Now we do typically see a pickup ahead of tariffs, like we did see, a lift in auto manufacturing visitation data as we got ahead of tariff periods. But I think you're right. As we look in the back half of the year, it's an interesting setup in terms of where we are, supply chain, inventory, pricing, everything. It could be a pretty interesting, and I think you're right. I think consumers have learned a lot of new tactics to kind of weather some of this, or at least mitigate some of this too. So I think that's going to continue to play on the back half of the year.
Yeah, but by the same token, one last thing there is that, right, everyone's had this kind of, let's say, push and pull. And if we end up, right, let's call it October, and it's, the headlines are a little bit more subdued, right? You could set up for a really nice holiday season. That's why, like, I know there's been kind of the negative Nellies out there, and I'm like, don't count out holiday just yet, because if you actually think about the weekly data, what's been driving it, and I think sales have been better than expected in aggregate, right? There's certainly more of a bifurcation than we've seen in recent periods, but timing wise, it could set up really nicely for holiday.
Yeah. It's certainly I think a possibility, and could swing that way too. So it'll be interesting to see, especially I think we'll get some tea leaves like we always do with back to school, and see what happens when we start to see more of the data there. One of the other ones that we haven't talked, we mentioned it earlier, is one of those factors we saw kind of in February, but it's also kind of been a factor, I think, throughout much of the summer. Crazy weather, and we were all talking beforehand how crazy in our various locations, whether New York or Chicago, humid. But obviously, there's been a lot of areas of the country that have been impacted negatively by weather. Put a couple of the different markets here too. Obviously, Texas, well known with the unfortunately the tragic flooding in that region, but the Northeast too has been one of those areas where I think the hot weather or the rainy weather on any given weekend certainly impacted certain retailers. Some of the sporting goods companies we talked to said that the Northeast was particularly challenging in terms of weather. So I think that's been another factor that's maybe not getting a lot of headlines here, but it's been a challenging weather summer in 25 so far.
We've also seen some, it's interesting. I wonder the impact, right? We look at, kind of AQIs, air quality indexes, and you've seen kind of for an extended period some of the weakest AQIs across the country. And so depending on, right, if you've got, kind of any one of a number of conditions, the question is, are people staying put a little bit more? Is that changing anything in actuality? Probably, I mean, it has to have some impact. It just depends, kind of how much people are actually kind of looking at those numbers, and then is it changing their behavior?
It's interesting too, you bring that up, because most of the data we're showing here obviously is in-store visitation trends for retail. But one of the things that was interesting is we kind of look at our data, and this is something we've learned from some of our analyst customers too, is that if you use our data and compare it to, say, a company's overall comparable, either sales or visits, however they report, it's a good way that you can back into kind of the implied online number. And online retail had a strong first quarter. I would say, second quarter probably not quite as strong, but certainly playing out, in an interesting way too. And I think there may be some linkage on the weather here too, that may be driving people more to the online side of the equation too, which very interesting on that too, when you can kind of piece all the, put it all together here.
That makes total sense.
Looking at some of the categories here, I just want to kind of look at, and this will set the stage for some of the stuff we're talking about later, but just kind of look at what we're seeing from an overall essentials category. We showed that overall retail, but thought we'd break it down into some categories here. So superstores, which is going to be largely Walmart and Target, club, discount, traditional grocery store, which are your Albertsons, Kroger, H-E-B, Publix, groups like that, and then value grocery stores, which are largely your Aldi's, your Lidl's, Grocery Outlet, Trader Joe's on that as well. Kind of see that same roller coaster progression that we saw earlier this year, but we do see kind of that bifurcation kicking in a little bit here too when we look at kind of the what's doing well. Dollar and discount and value grocery continue to hold up very well. Wholesale clubs is the other one that really stands out. So you kind of see where that lower income consumer, and I think even that middle income consumer, this is where they're gravitating towards right now too. And I think it's interesting if we look at kind of the dollar and discount store, and we'll talk a little bit more about this as well. They've seen a lift in that, kind of, let's call it 50 to 100,000 in household income consumer. Warehouse clubs is actually interesting, where they've actually seen a decrease in the household income from their trade area. And I think it's interesting because it's not just the, I don't think it's not really low income consumers. I think it's a lot of younger consumers that they're picking up on that one, with maybe a lifetime of transactions ahead. So when we look at the data on that, it seems to be more, kind of the younger consumer, kind of younger millennial, older Gen Z who are starting families, kind of that's where we've started to see that pick up here. But yeah, so this is kind of interesting just looking at the non-discretionary. So we certainly see that value bent, but it's also, I think, seeing some of that impact of the middle income consumer with the data as well.
I mean, I think what's most interesting is kind of the value grocery versus traditional, right? After the failed merger with Kroger and Albertsons, what that ultimately means for the industry overall. And then if you think about new store growth, it's just not happening in traditional. In fact, net, if you look across mom and pops and the chains, right, you're seeing ultimately a contraction, whereas in value, you're seeing tremendous growth.
Yeah, and it's still, I mean, you're exactly right. We're just continuing to see Aldi continue to expand very rapidly. We're starting to see some other chains within that group expand rapidly. Some of these are still in the mid-single digit in terms of unit expansion. So, certainly more than we're seeing across the overall category right now. And what's interesting too, if you look at the placement of a lot of these stores, it's a different than it was just a couple of years ago. I mean, in the past, Aldi may have situated and kind of focused on more of a 50 to 60,000 household income trade area. That number has definitely gone up in their new store cohorts. That's up in the 80,000 mark, and it's certainly seeing some success there as well. So I think that's been one of the interesting takeaways, is the success that those retailers have had in picking up consumers. And it's interesting too, I mean, I don't think they're fully replacing that grocery trip with that Aldi trip. I think they're certainly kind of picking up kind of what are the essentials that I can get by and be okay with private label. Because at the same time too, we actually still see, and this to your point about bifurcation, the fresh format and kind of the specialty grocers have actually had a pretty good year on that front too. So I think it's kind of interesting to see how that food retail routine has completely shifted for a lot of retailers, and they've added Aldi and others to the mix now. But continue to shop around, as we mentioned, the people are still shopping a wider number of locations than they had in the past, although that's dipped down a little bit from 2024. But it's interesting to kind of see that interplay between the different categories.
No, it really is. And I think that you're continuing to see, this idea around convenience and, what that looks like for consumers. And it can go back to, whether it's online or BOPUS or, whatnot. But I still think that, right, how consumers define convenience and what they're willing to pay for that, I think that's something that we're continuing to see evolve as well.
Yeah, I think that's true. I mean, I think even in a value-oriented, a very price-sensitive consumer, they are still willing to pay a premium for things like convenience or differentiation. If I'm getting a product that I can't get anywhere else, I'm going to pay for it. Or if I think I am if I'm getting what I think is a value, I'm like, it may be a high price point, but if I feel like I'm going to get the full return on that investment, if you will, I'm going to pay for it. I think there still is that perception of, if it's a high quality product for, I'm going to be able to get many years out of it, or multiple meals out of that one meal, I'm going to still be willing to pay a premium too. So I think that's one of those things. Don't just mistake value for low prices, because if everybody is offered low prices, everybody, you'd think everybody would win, when that obviously is not the case. So I think that's one of those situations where value can have a lot of different meanings. And I think you're right. A lot of people are willing to pay up for certain things like convenience as well.
We have two questions in the chat. So back to the prior slide, did you see evidence of consumers stocking up on electronics prior to the announced tariffs?
We did see a little bit of that. So we did see July has been a pretty good month for the consumer electronics retailers, and I think some of that is that stocking up for any particular those categories that were going to be exposed to reciprocal tariffs. So we did see that. There was a pull forward in demand, and I think we've talked about a couple of the categories in there, but I do think when we look at kind of all the data, there certainly was a pull forward in the potential hardware categories that were going to be impacted by tariffs there. So there was some evidence of that, and there's been evidence throughout the year too. Although, like I said, some of the more recent visitation data has been skewed by the Switch 2 and some of the visits related to that.
Second question, January was interesting in that visits were up, but overall sales were down. Could this be a result of a rise in stores having more of an active role in supply chain, i.e. online purchases being returned in store?
Yeah, I think there's certainly an element of that too. I mean, that's always what we see during January time periods. So it's always interesting when you look at the data on January, because there can be a little bit of a disconnect between sales and the visitation trends. Obviously, shopping is the number one reason people visit stores, but there's other reasons too. And we look at things when we look at visitation compared to transaction, that conversion rate. There can be various reasons for that. And so I think that that thesis probably is some truth to it too. And again, just the fact that we were lapping a year ago. I mean, snowstorms in January 24 were pretty well known as impacting everything. There was like 2 or 3 weeks, solid weeks, where people were just not shopping. So just some easier compares there as well.
And then we have another question. Do visitation trends have implications for channel shifts, e-com versus in-store? Any insights on the same?
Yeah, it's a good question on that in terms of channel shifts. I mean, we have started to see, I would say, some movement away from the superstore channel. I would say the superstore channel is interesting because you've got kind of a couple different trends going on. If we go, we didn't talk a ton about this, but you got Walmart, who obviously we talked about the Prime Day and their own spin on it, did a good job at that. They've quietly been shrinking their store base and kind of optimizing the store footprint, which I think every retailer should be doing right now, because no matter where you are, your trade areas have shifted. So I think that's been one of those things, one of the reasons why it's down. But then obviously you've got a situation like Target, which we're going to come to that as well, which has had a lot of things going on, to be honest. In terms of different trends there, in terms of consumer behavior, between different things going on at senior leadership, between different things from a merchandising standpoint too. So I think that's a category that maybe seeing a shift away. We're seeing a shift away from superstores to some extent, into dollar, into value grocery, into club. I think those are the ones that have seen a big increase. I mean, and there's some other ones outside of kind of your traditional essential category. I mean, off price has been one of the best performing categories we've seen. Some of that is because of that inventory pull forward, and just being a favorable buying environment for a lot of the off-price retailers as well. So that's a category that's done exceptionally well. Thrift stores, another one that it's been interesting, has been very strong. Yeah, go ahead.
I would say they've also gotten great, right? The thrift stores have been able to pick up some great real estate as well, right? That's one of the things that, right there, I'd say their real estate prowess has continued to improve, and that's been interesting. And then I think the other thing to add on kind of Walmart versus Target, right? Walmart, I mean, one of the things I feel like gets lost, and I think it was like lost during Prime Day, right, is Walmart Plus members, right, had, it was very clear kind of what deals you got, when you got access, and Target was in this like middling of, well, you kind of are a member, but you kind of aren't, and and like they could, I mean, I was like reading all the material, I'm like, I can't even figure it out, right? And I know the company incredibly well, and so I think that they have struggled to figure out who they want to be. And so I think that those retailers, I think going back to, right, Best Buy, Dick's, Ulta, Walmart, those who succeeded during Prime Day, right, they have a very strong identity and they continue to lean into that. So I think it goes back to, from an execution perspective, that we're really starting to see those retailers and brands who've been challenged, whether it's leadership, technology, or otherwise, right? It's having a bigger impact. And we've got a bunch of questions. How impactful is precise customer segmentation in driving customer service today versus a few years ago? Good question.
Yeah, it's a great question too, and I think it's a big part of it. And I think, Deborah, you kind of nailed it right there in terms of the identity part of it too. I think that's been underrated factor, in terms of brand success in these days, is that it's pretty clear what that brand, the communication part of it too, understanding, who are my core customer segments, and what do those customer segments value, I think is extremely important in this environment. It sounds retail 101, but I think a lot of people, have tried doing too many things, try to cater to too many groups at once, and ultimately that makes the experience bad for everybody. I think that's been a big problem for a lot of groups out there. It's been one that I bring it up, from looking at restaurants for a long time too. But one of the big challenges with Starbucks is they opened up the door to mobile order and that convenience customer when the brand had been built on experience, and now we're in a situation where at least prior to Brian Nickel coming aboard, they had try to kind of satisfy both groups at once, which doesn't really work. And now they're in a period of kind of shifting back to more of that experience customer. But you see it across the overall retail landscape too, is that a lot of retailers, as maybe things have gotten a little bit tighter in terms of household budgets and that, they try to expand to a wider audience instead of really focusing in on who are the ones who really drive the most success. I mean, a name like Sprouts is one that always catches my eye this one. Because they've really focused on, at once upon a time, we tried to cater to everybody, but instead we started to shrink our stores, really focus on that high lifetime value customer that we know is coming back, that we do really well with. And I think that's an interesting strategy in this environment. And so, long-winded answer to say that customer segmentation and understanding who's coming back into your stores is extremely important right now. And I think that's one of those things that, especially as so much has changed and wherever you live, whatever markets you're in, that has really changed, particularly in I'd say the high growth areas. I mean, we've seen a lot of migration away from the Northeast and, kind of the upper Midwest and the West Coast, and that has shifted to the South. So Phoenix, the big four markets in Texas, Central Florida, Atlanta, the Carolinas. But in terms of the makeup, both ethnic, household income, demographic, it is very different from each of those markets. And so that's one of those things. And I think looking at a customer segmentation and making sure to understand who really is your core customer in this environment can help to shape a lot of those value add decisions going forward.
Well, and it's interesting, right? When you start to look at what matters to a customer, right? I had this amazing opportunity with a professor from University of Chicago, and it was, kind of looking at in a retail environment, it's really not that many SKUs that tell the customer that you understand them in their market. Like mayonnaise is one of them. I didn't know there were so many different kinds of mayonnaise, but right, like these, like mayonnaise, bread, right? Like there were certain categories, and if you nailed it, then you like really nailed it. And so it was fascinating. Like we looked at data like over time, all got to kind of nerd out together, and so that can be interesting. All right, a few more questions. With the ending of the de minimis exemption, what changes do you expect to see in the short and long run?
Oh, that's a great question on that one too. It has been interesting to kind of watch the impact, and I know you and I have had discussions on this too. The impact of some of the Chinese online marketplaces in terms of what we're seeing. And certainly the question is whether or not that there's been much of an impact on the dollar store category there too. I think there's been some pros and cons, whether or not seeing some of the because the increased charges for those guys, the de minimis for some of the online marketplaces, did that open up the door for some of the dollar stores to rebound, or is it just simply a fact that they're just because they're lapping a difficult year? So I think that'll be interesting to watch, kind of see what happens on that front. I almost think it's too early to tell. I am going to be curious to see what the data shows on that one too. Deborah, this one probably you spent a lot more time on than I have. So
yeah, I mean. I think that they were, right, it was President Obama who put de minimis in. I think some of these players were surprised it kind of existed as long as it did. And so, right, they changed a lot, right? And they had kind of, margin baked in order to kind of change some of their, let's just say, like last mile to improve efficiencies. So I don't know at this point. I mean, you obviously saw other retailers change kind of how they, right, with the Amazon hauls and whatnot, right, how they were competing. So it could also be that domestic competition improved as opposed to de minimis had this significant negative impact on those players. So I think that maybe it was a bit of both. I do really think we saw some of the North American retailers really lean into going back to like value. how to communicate that, and what it means for consumers. Okay. Do you have insight into C-store traffic trends in specific regions, states, or specific categories in relation to immigration crackdowns?
It's a good question, and it's something we have been keeping a close eye on. There's a couple different ways to look at this. One is that we can look at potentially cities in border markets, both southern and northern, and looking at potential changes in visitation trends in those markets. Certainly in Texas markets like El Paso, Laredo, McAllen. If you wanted to go over more west, you could look at things, San Diego, Yuma, Arizona, things like that. What's interesting about some of these markets is actually, if you look the last couple of years, a few of these markets have actually seen big increases in population. So that may be masking some of the year-over-year data. But when we look at it, there certainly is, it seems like particularly I would say since the beginning of June, when we started to see the Southern California protests, it does feel like there's been a bit more of an impact in some of those southern markets in terms of year-over-year visitation trends. Certain categories, home improvement, auto parts have been impacted as well. The other way we can look at this too is that we can look at, with our segmentation and the other data, we can also pull together and put a group of, say, Walmart stores that are in largely Hispanic trade areas and what might be the impact compared to the overall base. For much of the year, we actually saw for Walmart a case where the stores that were in largely Hispanic trade areas, generally underperformed. That got to, basically that gap narrowed out right around Easter. But then again, since the beginning of June, that's widened out again, and we're seeing those stores in largely Hispanic trade areas continue to underperform. I would say if we look at kind of other areas of the country, Southern California has been a weaker market since beginning in June. I think we've seen a lot of impact from that early on, or the last couple of months, and that's across a lot of categories. That we've seen it in grocery, we've seen it in superstores, we've seen it in QSR, quick service restaurants. So I think that there is some impact that we're seeing from different headline immigration type stories here.
Yeah, we've heard some, in some cases where you wouldn't have expected it. We've had just some fascinating, I have to say, right? I mean, dynamic environments definitely do push you to learn about things that you never thought that you would. And this was one of them, just kind of I would say it's much broader impact than many retailers and brands would have thought, right? Much, much broader throughout the country and not necessarily just in kind of the South border towns, et cetera.
Yeah.
And so that I think has been, where some retailers were like, "Oh, I'm very heavily Northeast." It doesn't matter, right? You're still being impacted, and so I think that's one of those takeaways, right? And you hear enough of those conversations, but each time I have to tell you, I'm sitting there, and it's like you're just like kind of processing, right? Like the overall impact, and it's and depending on what your population looks like, I think for some of these retailers, it could be 50 to 100 basis points of comp. I don't think it's immaterial. It's not immaterial.
No, it's not. And I think this second quarter is going to be, as we kind of get through the reporting season for a lot of these chains, I think that's going to start to show. There's only been a few retailers that have acknowledged it at this point, but I think we'll start to see a bit more as we get through the second quarter reporting period, because I think you are starting to see a more material impact. And I think, Deborah, you summed it up really well there too. It's not just those border towns. It is really a nationwide, across the country type phenomenon. It's not something that's just impacting a couple markets. That is pretty clear. Just those markets. So anyways, we should probably move on and get to a couple other topics. We always cover a lot of ground.
We have two more questions that came. So RJ, you're just so popular. We need to book once a month sessions with you, because
Sure.
I think you could just show up and could be like, ask RJ. So do you have some insights into any shifts of traffic from power centers versus enclosed shopping centers, RE, weather, product drops, brand repositioning stores? Oh, brand repositioning.
We get the mall. Let's save that one for the mall, because we're going to cover that when we get to the mall section. So let's put a pin on that one. Remember that one. So let's come back to that one.
Okay. One other, perhaps anecdotal, but we found Costco out of some generic products, including kitchen trash bags, parens, first time in 10 years. Are you seeing, or do you expect some product shortages? And is this due to the tariff situation? All right, I'm going to start with this one, because this is my whole target beef, right? I posted 2 different experiences. I have many more. And, I would say if you eyeballed it, right, their out of stock rates historically were around 12%, right? And it was not, right, and different retailers define in stock differently. Target defines it, it's in the box. It could be in the back, but it's not on shelf availability, which is why I think they've always had out of stock issues. Walmart defines it as on shelf availability, so it's a different definition. So they're measured differently. But we have seen, going back to strength of retail, certainly Target has faced much greater, kind of out of stocks and inability, right? During the pandemic, right? We helped a lot of retailers. Okay, so, P&G wasn't, however they handled the situation, probably not the best, but you thought you were getting this, you're not. Okay, so instead of 2 facings of your own brand, have it be 4. That I think is something that we're continuing to see. And I think, RJ, another topic for another day, but we are seeing, right, kind of, the whole CPG category is just, it's just gone to hell in a handbasket. That would be a whole hour unto itself. That's like drama.
It could be. It very well could be.
Upon drama. Don't even get me started, but that's a good one. But we're seeing, which is really interesting, right? This, and I think it's important for our conversation today, is the growth in private label. Going back to, it's like bumped up against the ceiling and broken through in terms of the, not only the actual overall percentage, but the growth. And right, that fuels, right, margins and allows these companies to invest. So I believe we're in a new dawn, a new day of private label. And it goes back to, kind of some of these, and I don't know if by the term generic, it's its own brand. If they're having challenges with their own brand, that's a whole different ball of wax. But we haven't really seen that across the board. It's been more on the branded side.
Yeah, I think you're right on that one too. I would completely agree that we're in a new age of private label at this point, and kind of that day of kind of settling around 25% private label mix has certainly been pushed well beyond that now, and a lot of these brands have moved past being, I would say, private label and really become their own standalone brands. Kirkland being the prime example of that on warehouse clubs. Actually, it's a good thing to let's skip ahead a couple of slides here too, in terms of we've got one on kind of Target and some of the ones that have gone through changes. Let's go one more here, because this is a topic, to your point about the management turnover impact too on Target, because I think you bring up a good point there too. And some of these chains that have gone through some of this too, some of the chains that are doing well, private label, execution on that, very stable on a lot of these fronts too. But we have noticed this when we put together some of the changes in terms of management too, that there could be some correlation with that too. And obviously part of it's byproduct of where they fit in, some of the channel shifts we've seen. But when we talked about this beforehand, I think you were onto something about some of the turnover changes and the impact it might have here.
Yeah, I also think that if it would be, this was something when I was on the street, it actually played significantly into our stock calls, and it was like management tracker, and now you can just pull this stuff pretty easily, but it was fascinating to also, I will tell you, where we would have, and this was some of the data that was a little bit less publicly available that we would track, was around merchants, right? Because when you started to see a lot of merchant turnover or merchants hopping, right? So somebody's moving from electronics to, kind of to home, to children's, to, right? Like when you start to see this kind of horse trading on the merchant side, that was usually not a great sign in terms of, right, like the next 12, 18, 24, 36 months. And so, of course, it starts at the top. So I would say chief merchant is usually one of those that I think is underrated when they turn over or maybe take a different role. But then certainly some of these like GMMs and DMMs, once again, a lot of the data is not always super easy to scrape. I would say those are the roles I really do pay attention to, because they say a lot about a lot, and ultimately that's your product that's on your shelves.
Yeah, I agree with that one too. we've got a couple other categories we just want to quickly touch on here. I know we're getting close to the end of time, and we got to cover a couple more topics here. But one of the things that it's been interesting to kind of take a look at. I mean, we've talked about some of the macro news, some of the other things impacting, whether it be weather, whether it be immigration, whether it be other factors as well. But one of the themes that we continuously come back to and we get questions about too is this kind of year of reinvention. And I know we've talked about this a couple of times, kind of this focus on health and wellness has been kind of interesting. And we've seen it with apparel retail. Apparel retail on a relative basis has held up well. We've seen it with fitness, and we've got some slides in here that show that fitness has generally been performing well. But one of the more interesting things too is that if you look at home furnishing, and you may like, wait, what does this have to do with it, with your health and wellness? Well, what we hear from a lot of our home furnishing retailers, well, if people are out there trying to show off their new look, their new wardrobe, well, of course, the next thing is that they also may want to spruce up the house. And maybe it's not a full-scale renovation. Maybe you don't want to do the full remodel, but home decor and home furnishings is really the category that's driving the success in home furnishing. And there's a bifurcation here too. We've seen certainly that some of the higher end brands like an RH and groups like that actually hold up pretty well here too. So it's kind of interesting, kind of the ripple effect. If you strip out all the economic noise right now too, there is kind of this undercurrent of kind of people, health and wellness, taking better care of themselves, and the impact that may be having across some other categories too. So it's been kind of interesting to look, and I don't know if that's something you're seeing with you and your discussions in the space here too.
It's interesting. So we do a lot of work in this space. Back to my Liam Fung days, I've learned a lot about the category, especially around furniture. And and just kind of the replacement cycle. So if you think about the fact that a lot of people replaced in 2020, typical replacement cycle is like 5.5 to 7 years. So we're there. And I would expect, I think this category went through some contraction because once again, people overspent in 2020. But we're starting to already, I think the data shows it perfectly here, right? We're starting to kind of see that pickup. And I think that this will also, I believe this one's going to have a longer tail to it, but typically you'd have now about let's call it an 18-month period where we see kind of an outsized, kind of percentage of the consumer's wallet being spent on homes. So I think it's interesting. I think it's, and I think that some of these migration trends certainly will change probably what some of the data looks like, but I think this category is one to watch.
Yeah, you hit the three big factors here. One is, what's going on in the home market too, and I think we probably need to see a little bit more in terms of, existing home sales, new home sales to really get this going. But I think you're right. We're probably on the cusp of another cycle here. The other being migration, and the other one too is that there have been closures, and that's been more impacting the value furniture side of the equation. Like groups like Cons, things like that have changed where people have been shopping in that category. Home improvement's been one that, again, if you kind of think about the replacement cycle and kind of the replenishment, home improvement saw that big spike back in the pandemic and actually lasted, past the pandemic for a couple of years, and then has since normalized. We do see a very price sensitive consumer, one that, particularly, if it's going to require financing, maybe pulling back on project. But we started to see a little bit of recovery in July. Maybe that was a little bit of delayed projects because of weather. We heard or saw evidence with the data, and we heard stories from a couple of the home improvement retailers. People just didn't get to that gardening project that getting until the middle of the summer because of just weather and other things that may be at play. This is another one too. I mean, I think this is interesting that there have been some real structural shifts in the way people shop, and obviously more people working out of their home, a lot more wear and tear. I do think this category still got some hope. It's been a little bit, a more difficult year in terms of things, but I do think this is another one that we could be seeing a replacement and replenishment cycle in the years ahead.
RJ, I just found there's like a whole Q&A chat. There's actually another 12 questions. So I know we're not going to get to them all. I understand that, but so we have somebody who's dialing in from the UK, so I feel like we should.
Sure.
So they asked this is Nigel Smith. Hi, I'm joining from the UK today. How much of these insights do you see mirroring across Europe? Good question.
It's a great question. So just for disclosure, Placer data right now, we're just US focused. But I'd say that and Deborah, back me up on this one too. Historically, when you see a trend in the United States, it typically start to see it in other, particularly Europe. We also start to see a lot of that same trend, and I would expect to see some of this take place as well in Europe. I mean, certainly different categories, certainly different dynamics in the retail markets in each one of those countries as well. But I could see some of the trends, particularly that bifurcation trend we just talked about. I think that's probably one that's going to continue to start to play out in the back half of the year. So I think that some of the applications today certainly apply to the European market as well.
Wait, I think we have to get, this was a great one. Joyce Meng asked, we've seen a more modest inflation goods print today based on conversations with retailers. Is it evidence of just limited price pass-through, absorption, or supply chain savings, or is more to come in 2H?
I think more to come in 2H. I don't think there really has been much in the way of price increases yet. I mean, we started to see some stories in July, and in our discussions with retailers, we started to see some. But I'd say that after the last couple of years and how quickly the consumers push back and how price aware they are, a lot of retailers have been very, very cautious in terms of price increases, and a lot more selective about how they go about it. So I think a lot of that is absorption right now. There may be some supply chain savings, and there may be some other things that they're doing to kind of offset that. But at some point, I do think it is going to come, and so we'll be interested to see when that happens, because it is pretty interesting how quickly consumers respond to that.
And I think I just want you to have the opportunity to talk about this. Are you tracking traffic and off-price stores like Ross, et cetera, that do not operate online businesses? Well, they do, but small. At least in my region, these stores are very busy.
Yeah, they're doing very well. It has been probably outside of, I'd say, I mean, we talked about dollar stores having a nice bounce back year. We talked about warehouse clubs being a group that have seen some improvement. I would say off price, if I had to say a category that's probably had the best year so far in terms of year-over-year visitation trends, I would say off price is probably the one that jumps out to me. Certainly TJX, both the TJ Maxx, Marshalls, and Home Goods have all done very well. Burlington doing okay. Ross has also held up pretty well. They have more exposure to some of the Southern California markets that we talked about earlier. So they've seen some disruption because of that, at least based on our data. But generally speaking, the overall category has been exceptionally strong.
All right, I'm gonna, we may bust through 12 o'clock, but I know you've got a few more slides to get through, and then there's one good question I want to leave till the end.
Sure. Why don't we just quickly wrap up kind of the year of reinvention again? Fitness is one of those categories that if anybody's covered or looked at the fitness category, in kind of years of economic uncertainty, your gym membership is one of those first things to go. But that's not happening this year, which is really interesting in a lot of fronts. Yes, I mean, some of the numbers are down and kind of on a decelerating pattern. Some of this is because of industry consolidation, but generally speaking, that normal attrition curve that you see coming out of the New Year's resolution period has really held up well. And it's almost this idea, I think, partially because you're seeing consolidation, you've seen the rise of the Planet Fitness and kind of similar competitors in the low price, high value gym space. Younger consumers also helping this out, but I think this has been one of those interesting things that typically this is not performing the way you typically see in kind of an up and down year. This has been a really interesting phenomenon that the fitness category has held up so well. Why don't we skip ahead a couple slides, Stephen? Let's get to the mall section. I want to at least cover that. So we can come back to restaurants another day. But this has been really interesting, kind of the mall category too. If we look at kind of the overall roller coaster, similar story here too. But one of the takeaways from us is that actually we've seen some strong months. And if you look at kind of year to date, indoors actually had stronger months in most than kind of open air and outlet. And what the thesis on this one is, and working with a number of these guys, is that a lot of the kind of mixed use strategy, kind of either implementing residential or including more areas for attractions and events and things like that. A lot of the indoor malls are starting to replicate the open air malls in that front and seeing some success from that. So I think that's kind of been one of the interesting takeaways when we look at the data by category here. Now, remind me again, Deborah, what was the earlier question on power centers? I want to at least answer that here.
So we're kind of looking at power centers versus malls and like where are you seeing better traffic, but I think you answered it.
Yeah, I think that we have seen that on that. I mean, power centers certainly, don't get me wrong, they've had continued to do well, and particularly those that had invested in mixed use kind of strategies early on, and kind of inventing the mall as a brand its own way. But yeah, it's been interesting to kind of watch this as well. The other one too, I wanted to cover on this one before we kind of get some final thoughts here is on the next slide. We started looking at malls by class, and we grouped malls by A++, which are generally going to be your luxury malls, Class A and Class B. We using a definition that we've come up with, it aligns really relatively close with what Green Street has done in the past, though, too. But looking at the different trends here, and not a surprise, this is again where your bifurcation thesis comes in again. Looking at February, everybody got hit, but as we move through the year, we've seen certainly the Class A++ malls do better than the Class B. Although I think Class B is still a very interesting space to be in right now, because there has been a lot of investment, a lot of things we're seeing, a lot of repurposing, a lot of new anchor tenants in this situation. Non-traditional anchor tenants also starting to help out in that. So, but we do see the bifurcation when we kind of break malls by class types as well.
All right, so I'm gonna leave you with this great question from our Q&A, which was, how do you think about kind of holiday this year? Do you think it's going to be early? Do you think it's going to be late? What's kind of the overall kind of thinking from RJ?
Yeah, no, I love our discussions here, Deborah, too. I mean, the Q&A from your audience is always the best, and these are always fun discussions to really dive into. It really feels like the true retail experts of the world here are always aligned with us. Holiday is going to be a very interesting one, because we've talked about all the different macro variables. Obviously, we've not seen big uptick in inflation. It'll be interesting to see how that plays out. I know consumers are watching and kind of keeping an eye on price sensitivity. I do think we probably saw a little bit of pull forward. People maybe started to buy ahead of the at least July, started to buy things ahead of the holiday, maybe just stash that for the holiday. So I do think we saw a little bit of pull forward in demand. I do think that it will ultimately depend on a couple of different factors, and it comes down to this every year too. I mean, one is inflation. I think that's still probably the number one. Two is kind of where we are in the job market. We've heard from a couple of retailers that we've talked to that layoffs in different verticals have started to creep in, and it's, I think, playing out a little bit of the bifurcation part of the story. But I think what would be interesting for the holiday too is that if we continue to see this bifurcation trend play out, we'll probably set up for an okay holiday. For better or worse, the higher income consumers become the bigger driver of spending and visitation for holiday. And if that group is pretty stable in terms of where we are in terms of stock market, housing market, that group really takes their cues from the asset markets out there. If that group is in a good position, then I think we'll end up with a fairly solid holiday period. But if we start to see more turbulence for those particular asset classes, then it could be looking at something a little bit weaker here too. I do, like we've been seeing it. I mean, we continue to see, this pull forward to back almost to October. I mean, obviously we'll see another Prime Day type event in the October timeframe. So I do think we'll continue to see a holiday earlier than ever, particularly with potential disruption in supply chain as we get to tariffs. So I think we are going to see an earlier holiday than we've probably ever seen before. So I know that was kind of a rambling answer, but that's my quick take on holiday for 25. Based on everything we see right now, probably okay, but there are a lot of variables between here and there.
Yeah, I'm 100% with you. I think it's going to be earlier. I think it's going to be solid, and I think it goes back to the consumer shopping for themselves, they're shopping for others, and I do think people do wait kind of for those deals, and which really now the October to December period. So I think it's going to be great. RJ, this was amazing. I feel bad that we didn't get to all of the questions. So
that's okay. Yeah, well, we'll have to do it another time. So
absolutely. Thanks so much. Always great. Really enjoyed it. Take care. We'll see you soon.
Thanks, everyone. Appreciate it.
Thanks.